Let's do a quick one. Here it is. I am looking at Bed Bath & Beyond. Ticker symbol is BBBY. Now, I got a tip, which is something I just looked into through something new called, it's not new, but it's new to me, something called Snyder's List. It is a website, I guess. I just peeked at it yesterday briefly, and I looked at the function of it, and what the person I spoke to told me, who had been trading for 40 years. Older gentleman, good, what a great guy, right? And he told me about this because we were talking about options. So he is a professional trader. He's somebody who's made a career, or done very well over decades of trading and seen a lot of changes. And as we were talking, he was a customer, and the topic came up. I was able to, carry a conversation like I knew a lot of things. I was excited, to say, calls, selling calls and put option spreads, covered call, naked calls, like all that stuff. I understand. I'm not a pro, but I know enough about it to have a conversation about it. Like if somebody is into sports and they know the stats and the players and that type of thing, what's happening, people will like, oh wow, you really know your stuff. So he told me about this thing called Snyder's List. I believe it's spelled SNIDER. And you just Google it, whatever. It's a place where you could see the best premiums. Because what I have found is the best, and this is about options today mostly, and the mention on the best success that he has had and I've been having with options is not gambling with calls or puts where you're buying them, like hoping that they go up or down. I've lost way more times than I've won practicing that strategy. If I do the leaps strategy, which is 1 to 2 years out, I have had some better success with that, right? Because there's enough of a time frame where you're given the time to recover one way or the other in most cases. Okay, depending on the company and the news and all that type of thing that's happening in the world, pandemics, right? Those type of things. But Bed Bath & Beyond is something he was talking to me about, and I've actually traded this company a few times. I mean, most of us know this company. So I have a 4-hour chart. If I just kick over to a 1-day chart, you can kind of let me get out of the way here. You get a better view. You could see, what I usually look at is I look at this 200-day or 180-day moving average, and if I see the price action is above that, it usually means strength, or a sign of strength on an uptrend. And when it falls below that, that line, which it has in the past, week or two, or whatever those candles represent. Let me see if I zoom in a little bit here. It's probably going on 2 weeks now. That's fall below that. Now you can see where on the 9-day moving average, which is that blue line, right, which is that line right there. It stayed under that, right? So it's not the price action can't seem to get over it, but it is drawing closer, right? Drawing closer meaning those candles are now kind of touching on that. And we're going into an earnings report, I believe on the 30th. So the end of this month, 9/30/2021. So I've experienced it most times when you buy shares or options going into earnings, it usually, depending on how they report, how the company reports, it may not work out. Like it usually falls. If they have a strong earnings report, even still. So I've been trying to stay away from that. I haven't had a lot of success. So what he was saying was you buy in, collect the premium, and get out before the earnings report, right? So what I've been looking at is when I use Robinhood, I kind of look at it and I say, well, what's a far out leap, right? The leap is 1 to 2 years out. And if I go back here and I'm like, what was the all-time high over here? Not all-time, this year it was $53, $54. All right. And then I look at this, kind of this support line where it's kind of hit that line several times. You can see that, right? that 2350 area, a little below it, a little above it, right in that area around 2350. And then the high point being, save that. Come on. Up here. So that's a big. Do I think it's going to go up there? No, I don't think so. Is it going to go up there? I don't think so. I think it might go around here. Yeah, I mean that looks a little bit more realistic. That 30 range. So let's call it 6-7 points, spread wise. If it can get back up there. So if I look back at this option, depending on what you're doing. Now again, you might have a couple $100 or a couple $1,000 of all the money that you might be willing to, speculate or invest, one of the two. So if I'm buying an option, if I'm going to buy shares, I might say, all right, well, I could buy more shares. It was up at 30 at one time. So it basically cost me $575 to buy a $30 call, right? The strike price, $30 call. So if I was buying it in 2023, that's how much time I'd have to, until the end of the year and all of next year before it did not hit 30. It cost me $575 in premium if that's what I wanted to try, right? So meaning like, okay, it's a $5.50 to $6 spread. If I was to, take a shot at $5.75, that's what it would cost me. Again, I can on whatever platform you're using, I could put the lower end. I could put $5.55, and if somebody fills my order, I'd have to pay $500. I'd have to have in my account, or if you have a margin account, which I don't recommend, $555 available to hold that contract until January 2023. And as that premium goes up, if it goes to $565, $585, $625, right, then I make the money from $555 up. The longer I hold the contract, the more that I lose my premium. But I could always get my premium back. But if the stock somehow goes to up $20, if it goes to $50 or $40, then I make $100 for every dollar it goes over $30, right? So if it goes at $50, I make $2,000. If I hold it, and I can sell it at any time, as long as somebody will buy it, as long as there's a buyer there, I can sell it at any time. So that's what I'm looking at. Do I do it that way, or do I want to own 100 shares, which is also not a bad option. So if I was to sell a call or sell a put, right, the other idea is, okay, I would now change my spread from January 2023 to say October 1st, which is a couple weeks away, right? Less than 2 weeks away before the earnings on September 30th. So now if I want to buy some contracts, I'm like, all right now it's at 2370. Do I think it'll go up into earnings? Now, I have not researched the company today to see how they're doing, like what's going on with the company, if it's most likely they're not going to report good earnings. Or overall how they're doing. Are they doing online business, and how their retail stores are doing? But if I had to guess, I would probably think it would go up towards 30 before earnings at least. So if I was to say I'm going to sell a put, that means I'm willing to pay, let's say $20 a share. So if I get 100 shares, that's $2,000. Right now it's at 23, so that's a discount if I lose. Meaning, like, if I get filled, I got to buy 100 shares at $20 a share, which is $2,000 for 100 shares. And I do collect that premium of $42. See here it says minimum credit. Minimum credit, $42. So like an insurance agent, I'm saying that for 2 weeks, no matter what, whether I get filled or not, meaning like if it doesn't go down to 20, I still get the $42. If it does go to 20, I still get the $42, which would average out my cost. I understand that, right? And then so I'm like, all right, that sounds not bad. So let's say I own 200 shares of Best Buy and Beyond at BBBY at $20 a share. The upside is I think it goes back up to 30 at some point, unless it's really sucking, right? So I'm like, that's great. I'll do that. $20 a share plus the $84 in my pocket. I'd be willing to risk $4,000 for that because I own the shares and I can just hold them, and eventually maybe it gets back up. If I wanted to buy the shares, All right. Other option is I sell a call, which I don't own the shares, so I can't really do that. If I had owned 100 shares, and if the strike price is $23.70, I'm like, all right, $23.70 is what it's at. I own it at $23.70, let's say, and I think it could go up to 30. So if I was to hold that, well, the premium isn't that high. So let's say $27. All right, I'm willing to sell my shares if it hits $100. So I'd get $50 plus the spread between $23.70 and $27. So let's call that $3, right, or $3.30. So let's just say $3. So I make $3, right? So I make $300. I make $350. All right, and if it goes up to 30 or $50, I miss out on that with those 100 shares. But I get the $300 and the extra 50 if I just don't think it's going to really move that much, and depending on how many shares I'm willing to sell. But also, if it doesn't sell, I still have my shares, and I get the $50. So obviously, the higher the premium, the more money you're banking, and depending on your strategy. And that's something I've been learning. So when you own the stocks or willing to buy the stocks, in this case, I mean, the premiums usually aren't as high, but they do give you a better probability of making like a small percentages, 1, 2, 3%, whatever, each time you're doing this. So that's what I've been practicing, and I'm just trying to scale each time, because obviously if you can buy 2, 3, 4, 5, 10 contracts, you're going to get this number, right, times. If you go back to this one, if I said, okay, I'm willing to do that same thing, but I want to sell, I have 1,000 shares, right? I'd make $500. So I'm like, man, great. I had 1,000 shares that I own anyway, long term. If it doesn't go up to $27, I made $500 for just sitting on those same shares. Why wouldn't you want to do that? So you're going to buy stocks, of course, that are affordable and that you like long term. And that's what I'm doing. So as far as that goes, that's been my strategy. So this is just an example of the thousands of companies you can buy and sell in a volatile market. My wife. But anyway, I'm going to go. I hope that helps a little bit. It's just a little peek at my strategy and what I'm doing as far as options. Oh, no. All right. Talk to you later. Oh.